Good day, students. Today we're going to do a question. It's a financial statements question. I'm going to do the two statements. This question has already been loaded on Vutela. It's Xhosa Limited. And then we're just going to do it step by step. So we're going to start. Remember, there was a video that was loaded. And in the video was basically the rules that you need to know before you starting your question. Now, I'm just going to show you all the calculations. Now, what I'm going to do now is basically what was in video, the video part 1. So we're just going to do this step by step. And I can guarantee you, if you follow the steps, you will be able to do this question. Okay, so let's start. Step 1. Step 1, you always go and see what is the financial year end. If it is given, you need to determine what is the beginning of the financial year. Now we're going to start. It says Xhosa Limited has provided you with the following information that relates to the business activities as at the 31st of December. So what have they given us? They've given us the year end, right? So if they've given us the year end, we need to determine what is the beginning of the year, which is 31 December 2017. That's the end of the year, so our beginning of the year will be the 1st of January 2017. Now, the reason why this is important, this is always your opening balance and this is your closing balance. Remember, I explained to you that financial statements is done over a 12-month period. So from the 1st of January 2017 to the 31st of December 2017 is 12 months. Now the reason for that, you remember we have two statements that we need to do. We need to do the statement of comprehensive income. That statement will determine what is the profit and the loss of a company. The other statement is done, which is called the statement of financial position. Now those two statements, the first statement we do over the period. You'll see it says for the period, for the year ending. So we're going to look at all the income and expenses during the whole year, and then we're going to work out what is the profit or the loss at the end of the year. But the statement of financial position, we don't look at what it is during the year. We go to this point in time and we only do our statement at the end of the year. Okay, so that's why for a statement of comprehensive income, you're not allowed to carry over any income or any expense. The reason is, if you give someone or if you sell something for the year, who will agree that I sell it to you this year, you can only pay me next year? Now, with income and expenses, it means if you sell something in the year, you must get payment in the year. If you've received service within the year, you must pay for the service within the year. Now, there's something called an adjustment. Now, an adjustment is everything that should be in the year that is not, or everything that's not that should be. Now, we're going to get to that now, right? So now, step 1, you go and check what is the year end, and then you go and check, because we know the beginning of the year will be the 1st of January 2017. Then you go straight down to the requirement of the question. The reason is the required gives you direction, what it is that we want from you. Now we want you to calculate or to prepare the statement of comprehensive income for the year ended December 2017, and we want you to prepare the statement of financial position. Now, what is the two statements, right? The first statement, what's our formula? Sales less cost of sales gives us gross profit, right? plus other income gives us total income. Less expenses gives us EBIT. Less interest gives us earnings before tax. Less tax gives us EAT. Now, EAT is actually your net profit. Now, this net profit, you're going to need this in your statement of financial position. And what's the formula of our statement of financial position? It's assets, non-current assets plus current assets equals to total assets must be equal to equity and liabilities, which is equity plus non-current liabilities plus current liabilities equals to total equity and liabilities. So when these two balance, then your statement of financial position is balancing. That is your step one. So what did we do? We identified our financial year end, and then we identified what is it that is required of us. Step two. Now remember, I posted this on Vutela for you as well. You need to know what the elements are. And when we're talking about elements, we're referring to non-current asset, current asset, expenses, income, owner's equity, non-current liabilities, and current liabilities. Now, these are all the elements below, right? Equity, we have drawings and capital. Expenses, we have all these, and income, we have all these, and then non-current assets. Liabilities, we have long-term loan. You can even write in the mortgage bond. This is also a non-current liability. Okay, so know this because we are going to need it in our question. Okay, so step two, we're still busy with step two. We're going to identify what is all our elements. Okay, so we're going to start with capital. Capital, we know, is our owner's equity. Mortgage bond, non-current liabilities. Land and buildings, non-current asset. Motor vehicle, non-current asset. Furniture, non-current asset. Drawings, owner's equity. Accumulative depreciation, we're going to skip. Then we're going to go to fixed deposit, is a non-current asset. A loan is a non-current liabilities. Accounts receivable, the other name for accounts receivable is called debtors. And this is a current asset. Inventory. Now, can you see why it is important that we needed to get the beginning of the year? Our beginning of our financial year is the 1st of January. Now, can you see inventory year says the 1st of January. So we already know this is an opening balance, right? Now, remember in our video, while you are going through this, you need to go and look. Did they give you a cost of sales amount? If they gave you a cost of sales amount, use the amount as is. If they didn't give you a cost of sales amount, we now need to look for elements to calculate cost of sales. Okay, so let me just do this quickly. So, what are we going to look for? Firstly, one, we identified our financial year, which was the 1st of January 2017 to the 31st of December 2017. Secondly, we must go and identify, is cost of sales given? If it is given, we use as is. Right? If not given, you need to calculate it. And how do we calculate cost of sales? Opening balance inventory plus purchases plus carriage on purchases minus purchase returns minus closing balance inventory, and the total of this is my cost of sales, right? The third thing we need to go and look for, right? As we're going to go down our list, we need to go and identify what are our adjustments. Now, our adjustments is, remember, you always need to pay expenses for 12 months, or you need to receive income for 12 months. But if you received or paid expenses for 13 months, it means that 1 month is too much. You need to minus the 1 month to get your 13 months to 12 months. If you only paid for 11 months, it means there's 1 month short. Then you need to add 1 month to get it to 12 months. This is called adjustments. Now remember, I explained this to you already. Now this is the table I want you to memorize. Statement of comprehensive income, statement of financial position. These are your assets, these are your liabilities, this is your income, this is your expenses, right? But let me try and explain this to you once again. An expense on its own is a bad thing, right? So if you have an expense that heaps up, which is called accrued, right? It means if you must pay me 50 Rand, and now you didn't pay me 50 Rand, next month you must pay me 100 Rand. Why? Because the expense accrued. It means it's a liability, because now, remember, an expense is not good, a liability is not good. An asset is good, and income is good. So now this expense that's not good, when it heaps up, you need to pay me more. Now remember, a liability is all the people you owe, and an asset is all the people that owe you, which is good, right? So an accrued expense, you need to add to your added to your statement of comprehensive income, and it must go to your liabilities. Now, the opposite will be for income. And then let's take same example. If you need to pay me 50 Rand, right, for 2 months, but in this month you pay me 100 Rand. Next month you don't have to pay me, I owe you 50 Rand. So that means that your expense now is actually good for you, because you don't owe me next month, I owe you because you paid me extra. So for a prepaid, you must minus, and it will go to an asset. Now guys, go and study this table. Okay. And then remember, adjustments is also depreciation, fourth. Then you're going to look for depreciation. What's important? We need to go look for the method. Okay, so let's start with our question. Okay, so now we're still naming all the elements. Then we have bank balance. Remember, when bank balance is a debit, it's a good thing. It's an asset. If it's a credit, it's a bad thing. It means you owe the bank. So this is a current asset. Accounts payable, what's the other name? Creditors. Creditors is when you owe someone money, which is a current liability. Then we have sales, we have purchases, we have sales returns. Now remember what we said. While we are naming this, we need to go and see, are we given a cost of sales amount? So let's just run through it. There's sales, purchases, sales, returns. Salary, wages, telephone, water rates, bank charges, carriage on purchases, advertising, carriage on sales, electricity, postage, insurance, bad debts, general expenses, interest received from investments. Can you see the cost of sales has not been given? So if cost of sales has not been given, we must calculate it. And then we need to go and look for the elements to calculate cost of sales, which we already found opening balance inventory. Now we must find purchases, carrying on purchases, purchase returns, and inventory closing balance, right? So here we have sales. What sales? I'm just going to write it here. Sales is income. Purchases, okay, remember this is our cost of sales calculation. Sales returns, now sales returns is just basically you taking back something that you bought. For example, if you go to Truworths, right, and you buy a few clothing items and it's going to cost you 3,000 Rand. Now you don't fit on anything in the shop, you go home and you fit it on. When you get home, you find out that one of the jeans that cost you 1,000 Rand does not fit you, right? So when you left the shop yesterday, they said you owe them 3,000. Then you get home, you fit on the jean, it doesn't fit you, you're going to take it back. So when you take it back, you're giving them back the 1,000 Rand jean. So it means that your sales is no longer 3,000, it is only 2,000 because you took back the sales, right? Sales returns. So we know with sales, we need to minus sales returns. You can write it here. Then we have sales returns. I'm going to skip it because I already wrote it there. Salaries and wages is expenses. Telephone, expense. Water rates, expense. Bank charges, expense. Carriage on purchases, it's part of my cost of sales calculation. Advertising, expense. Carriage on sales, remember in the video I told you guys, make sure carriage on sales is an expense. Carriage on purchases you use in the calculation. Electricity, expense. Postage, expense. Insurance, expense. Bad debts, expense. General expense, expense. Interest received, right? This is not interest paid, it's interest received. Commission received, meaning once you receive it, it's an income. So this will come under other income. This will also be under other income. SARS paid, right? Tax paid, this is an expense. Interest paid, this is an expense. Purchase returns, this is part of my cost of sales calculation. Okay, so I've done that. Part of my step 2, I need to go to my additional information. Okay, so I'm going to put this up here, and then I'm going to use just the page. Let me just turn over the page and use it to do our calculations. Now guys, this is what you can do. On your answer sheet, on a separate page, right? Or you can even do it on your first page. Do all your calculations and then you can just carry over the amount. Now A says wages, right? What do we know of wages? Wages is an expense because you must pay it. They're saying wages still owing. Now, if you are still owing something, it means it's not paid yet. So it is in arrears, right? So still owing, so that we know the wages is in arrears as at the 31st of December, and it is 25,000, right? So it is still owing, meaning it's in arrears, and when something is in arrears, we call it an accrual. It's going to heap up. Because what's going to happen? Next year, they must pay wages plus the 25,000 because they did not pay it this year. Right. So we already know. With this, it always affects 2 statements. Now, I need to tell you something. In accounting, there's one golden rule. The rule is for every debit, there is a credit. What that rule actually means is that for every one leg, there must be another leg. Like for example, let's bring it home. for every child, there must have been a mother and a father, right? For a child to be there, there must have been a mother and a father. Whether the mother and the father is alive is irrelevant. There was a mother and a father for there to be a child, right? So the wages is, what's the amount? 25,000. But we know that it's an expense. So we are going to account for this expense in the statement of comprehensive income. And for the accrual, we are going to account for it in the statement of financial position. But now we need to know where are we going to account for this thing in the statement of financial position. Then we go to our table, right? We know that it is an expense. The wages is an expense. Right? We know that it is accrued. So where does these two meet each other? Right? Down there, down there. So we know that it is a liability. So what are we going to do? We're going to add it in the statement of comprehensive income, right? And we're going to account for it under liabilities. So what do we write here? We know that in the statement of comprehensive income, we're going to add it, and here in the statement of financial position, it's going to go under current liabilities. Okay, that's A. B, closing inventory, right, which is closing balance inventory. This we're going to use in two places. The first place, we're going to use it in the calculation of cost of sales. And in the second place, we're going to use it under current assets. Why? Because it's a current asset. Then we have, and what's the amount? 210,000. Then we have C. Now what is C? C is insurance. And what happened to the insurance? They said the insurance has been prepaid. So it's paid before the time for 3,000, right? So we know insurance has been prepaid. Sorry. What's insurance? It's an expense. Where do I account for an expense? In the statement of comprehensive income. My prepayment, I must take to my statement of financial position, because remember, I must now take it out. This one I added in because they paid for 11 months. Remember I told you they must always pay for 12 months. So we added the 1 month to the year it should be in. This one is prepaid, meaning they paid for 13 months. So that means we must minus it out of the statement, and we must add it in our statement of financial position. But where do we add it? Sorry, we go to our table again, and we know that insurance is an expense, right? But this expense is prepaid. So can you see where the two meet? So it must be an asset. So prepaid, see, we must minus it out of the statement of comprehensive income, and we must add it under assets in the statement of financial position. So we go here, here we know it must be current asset, and here we must minus it. Then we go to D. D is depreciation, right? Now remember with depreciation, there's two types. Okay, let me write here depreciation. There's two types. Now there's actually four, but in this study unit that we are doing, or this module, we're only going to use two. The one is called straight line or cost price method. The other one is called reducing balance or carrying amount method. Now the formula here, when it's straight line, you go and look for the cost price. So you take the cost price, multiply by the percentage. With the reducing balance, you go and do a calculation first. There's a formula. It's cost price minus accumulative depreciation gives me my carrying amount, right? Then your carrying amount, you will multiply by the percentage. Okay, so let's look at what the question says. The question says depreciation of 20%, let me just zoom that. Depreciation of 20% using the reducing balance method on the motor vehicles, right? So yeah, the motor vehicles, they're using the reducing balance, and it is 20%. And 10% using the straight line method on furniture. So here is furniture, and furniture uses 10%. Okay, so now let's calculate our depreciation. So depreciation here, we will calculate by saying cost price multiplied by percentage. What's our cost price? Then we go to our question. Furniture at cost is 340,000. Furniture at cost for motor vehicle is 700, right? So it's 340,000 multiplied by 10%. So our depreciation is 34,000, right? For motor vehicles, remember, it's the reducing balance. I first need to do the formula. Accumulative depreciation gives me my carrying amount. Now, what's my cost price? My cost price on motor vehicles is 700. My accumulative depreciation on motor vehicles is 150, right? So cost price is 700. Accumulative depreciation is 150. I minus it, gives me 550,000. Then I multiply this by 20%, which my depreciation will be 110,000. Okay, now I have a question for you, right? This is depreciation for this year. Remember when I explained some of the stuff for you? When I explained retained earnings, I told you that retained earnings and depreciation works the same. It's exactly the same thing, but it's just a different name based on the year. Let me show you what I mean. Let's say, for example, we have 20, okay, this is depreciation. This is accumulative depreciation. We have 2020. Then we have 2021, 2022. Okay, 2020, let's say depreciation was 10,000. You bought the car in 2022, right? So you bought the car, yeah. Meaning you will only have depreciation. You will not have any accumulative depreciation because nothing was depreciated last year. You only have the car this year. Then next year, right? Let's say the depreciation is now 5,000. It means accumulative depreciation will be the 10,000 you depreciated last year. Okay, let's say 2022 depreciation is 20,000. Accumulative depreciation will now be your depreciation of last year and the year before. So that means your cumulative depreciation will be 15,000. So if we need to work out what is a cumulative depreciation for our furniture and what is our cumulative depreciation for our motor vehicle, what was the accumulative depreciation that they gave us on the question for furniture? They said it is 58,000 and 150,000 for motor vehicles. So that was our accumulated depreciation, right? So it's 58,000 and 150,000. But now remember, this is the statement of financial position. Now the last day of the year, depreciation now becomes accumulative depreciation. So what will my new accumulative depreciation be? It will be the 58,000 plus depreciation of the new year. So my new accumulative depreciation will then be 58,000 plus 34,000, 92,000. And this is what I'm going to use in my statement of financial position. Okay? Here it's 150. What's my new depreciation? 110. So it's going to be plus the 110,000. So my new accumulative depreciation for my motor vehicles will then be 150,000 plus 110,000, which will give me 260,000, and this is what I'm going to use in my statement of financial position, statement of financial position. Okay, so we're basically done with all our calculations. All we're going to do now is we're going to start with our question. Okay, but this sheet, keep it. And guys, when you do calculations, do not do it on your question paper. Always do it on the answer sheet so that we can see how you got the answer. Okay, so our first statement that we are going to do is going to be our statement of, so it will be statement. Now, where do I get this heading? It's here at the bottom. You rewrite it as is. All you need to do is you need to put in the company name. So you're going to say statement of comprehensive income of Khoza Limited for the year ending 31st December 2017. And then you're going to start. What's your framework? Sales. Remember, minus your sales returns. Then you're going to say less cost of sales. Already know they did not give us a cost of sales amount. We must calculate it. So we're going to say opening balance, inventory, plus purchases, plus carriage on purchases. Now can you see I'm just doing the framework. Purchase returns minus closing balance inventory is equal to gross profit. Right? So when I did my naming of my elements on my question paper, I remembered I've got two other income. So then I'm going to say, plus you add other income. My one other income was interest received from investments The other one was commission received. And then equals to total income. Then I say minus expenses. Now what I love doing is I do it up till here and then I stop. I finish my first part and then I basically go and do my expenses. Okay, so gross profit, I know it's a total income, I know it's a total as well, and I need to have a total with my cost of sales. Let me just reduce this a bit. Okay, then I take my question and I basically go and let my framework lead me. Now, if you can notice here on your question, everything below sales is income and expenses. Everything above sales is either owner's equity, either assets, either liability, meaning that everything above will go to the statement of financial position. So I'm not even going to look there. The only thing I'm going to use here is going to be my opening balance inventory. And everything below this will go to my statement of comprehensive income. So I'm actually working with everything here and then with only my inventory opening balance. So then I'm going to start, right? I'm going to go and look what sales is. My sales is 1.3 and my sales returns is 2,000. So I'm going to tick it off because I've used it already. So then I go and I say 1.3. Now I always love writing my answers here before I write an end answer. Because if you make a mistake here and you didn't show a calculation here, your whole thing will be wrong. But if you showed a calculation here, you add up incorrectly, we will mark this part. So it's minus 2,000, right? And then I'm going to do my cost of sales, right? So what's my opening balance inventory? My opening balance inventory is 192. I tick it off because I've used it already, 192,000. And then I go to my purchases. My purchases is 609,100. I tick it off, 609,100. Can you see how your framework now leads you what you need next? Now I'm looking for carriage on purchases, 1,000. I tick it off. I write here 1,000. Then I have what's my next one? I'm looking for purchase returns. There's my purchase returns. It's 3,000. I tick it off. So I must minus the 3,000. My next one, I need to look for closing inventory, which is 210,000. But remember, we need to use it twice on our calculation. So we're first going to use it in our calculation. So we've done that part already. So we're going to minus 210,000. So now I'm going to add up this part. This block will then give me my cost of sales. Okay, so let's first start with the sales minus sales returns. So it's sales, okay, it's 1.3 minus, so it's 1,298, 123 minus cost of sales, which is 192 plus 609,100 plus 1,000 minus 3,000 minus 210 gives us 589,100. So we take the sales less the cost of sales will give us our gross profit. So my gross profit is 708,900. Then I'm going to do my other income. So I'm going to put it in here, and then I'm going to add this block. Okay, my investments received, my interest received from investments is 60,200. Okay, 60,200, 60,200. And then the next one I'm looking for is commission received, which is 40,800, 40,800. And then I add this up. 60,200 plus 40,800 is equal to 101,000. Then I need to add this up. This will give me my total income. Gives me 809,900. That's my total income. Now I'm going to do my expenses. Now what I do, I go and write depreciation first, because remember, depreciation was a calculation you had to do, but it's not on this list. So for you not to forget to write it, you go and you write depreciation first, then you go, you do your wages, then you do your insurance, and then you know that you are done with this, and then you can continue with your list, okay, by ticking off. So my expenses, I will start with my depreciation. And do yourself a favor, rewrite, don't write the formulas, just write how you calculated your depreciation. Okay, so let's start. I'm going to rub this out. Let's say motor vehicles. We're going to start with motor vehicles first. What did you use for motor vehicles? 700 minus 150 gave you 550 times 20% gave you 110. So I'm just going to write it in here. 700 minus 150. So I'm basically just rewriting my calculation. Times 20% gives me 110. Because if you might make an error and you don't write 110 here, but we're going to look at your calculation and you will still get marks for it. Then we have depreciation for furniture. What was furniture's calculation? 340,000 times 10% gave you 34,000, right? So you go on your question and you mark off D. You've done with, then you go and then you're going to do wages. So you're going to write, now what does it say on the sheet? It says salary and wages. Okay, so you're going to write salary and wages. Always open the bracket and write what is given to you. It's 210. So it's 210, 220. And what must you do with salary and wages? Now remember with salary and wages, we said it must be, no, this is arrears. Is it arrears? Wages is still owing. Yes. You must add it to your statement of comprehensive income. So we're going to take and we're going to add the 25,000. We close the bracket because we know we're done with that. So we're done with A. Then we're going to do C. C is insurance. So we write there insurance. We open the bracket to see what was given. What was given on insurance? 32,700. So we say 32,700. And what did we say? What must we do with it? We must minus it from the statement of comprehensive income. So we're done with this part. We're done with this part. So we must minus the 3,000. And we close the bracket, right? And then we just continue. So now we're done with salaries and wages. And we are done with insurance. And then we just follow all of them. After everything is ticked, you must know then you are finished with your statement. So then we have telephone, and then let's just do this. So we take it, and you basically just write it from, so you write telephone, open the bracket, 31,800. Remember, you didn't have to do anything with telephone, so you can just take that amount to your end amount. Water and rates. The amount is 29,500. You didn't have to do anything. There was no adjustment there, so you just carry it to your final amount. Bank charges. 5,500. You didn't have any adjustments, so you take it to your end amount. You tick it off. The next one is advertising. Open your bracket. Advertising is 33,200. There was no adjustment to be made, so you can take it to your end amount. Carriage on sales. Open bracket, 8,700. There was no adjustment, so you take it to, the only time you will not just take the amount to your end amount if there was an adjustment, right? So carriage and sales we're done with. Then we have electricity. Open it, 54,400. We take it to the end amount because there was no adjustment. Postage and stationery. $28,500. Take it to the end amount. We've got bad debts. Can you see how your framework has basically led us how and what needs to come next? And then we have general expenses, which is 10,600. Okay, and what else do we have? Now we have interest and tax, so we know is equal to EBIT. Okay, so now we need to add up this amount, which is our salary and wages, 220,000 plus 25,000 equals to 245. And then we have 32,700 minus 3,000 is equal to 29,700. Right, now you must take this block and add it up, and then you're going to say your total income minus your total expenses will give you EBIT. Okay, so let's go. Let's first make sure, can you see, okay, before we even write EBIT, then we're going to say less interest paid is, you can write it, yeah, 5,000. There was no adjustment, so we just bring it over 5,000. Then we get is equal to earnings before tax. Then you say less tax paid. Tax amount is 10,000. So it's minus 10,000 because there was no adjustment. And this amount gives us our earnings after tax. This is our profit or our loss, and this amount you now need to take to your statement of financial position. Okay, so now let us do our calculation. But before we do our calculation, let's just make sure that everything below the line has been ticked. Okay, we've used all this, and now we've used tax, and we have used interest. So we're happy that our statement of comprehensive income is fine. All we need to do is now just do our calculation. So let's start. So we're going to say the 110 plus 34 plus 245 plus 29,700 plus 31,800 plus 29,500 plus 5,500, 33,200 plus 8,700 plus 54,400 plus 28,500 plus 19,000 plus 10,600 equals to 639,900. So we say 809,900 minus 639,900. Which gives us 170,000 EBIT minus 5,000 gives us 165,000 earnings before tax minus 10,000 gives us a profit of 155,000. This is the amount we will carry to our statement of financial position, which we will do in the next session. Thank you so much. If there's any questions, please email me. And that's all for now. We'll just continue with the next statement in the next session. Thank you so much.